We're going to look at the profitability ratios, and the three we're going to look at are profit margin, return on assets, and return on equity. So the profit margin we calculate as net income divided by sales. So if we go to the income statement, we can see our bottom line is net income, $57,411, and we can grab our net sales from the top, $274,515. And so when we divide the net income by the net sales, we get 20.91%. So 20.91% of our sales becomes net income. Or you could look at it as for every sales dollar, just about 21 cents becomes net income. And again, we compare that to our competitor. The higher the profit margin percentage, the better. The next profitability measure is the return on assets. What percentage do we get back on our investment in assets? So we get that by taking our net income and dividing it by our average total assets. And so we pulled our net income in the previous calculation. We said it was $57,411. And we go to our income statement to get our total assets. All right. Beginning of the year plus the end of the year, come to a subtotal and divide by 2. We make sure that our net income, that's the same net income that we used up above for the profit margin. Our average total assets, we use these in the total asset turnover up above, 331,202. So when you're doing calculations, that's a check. Make sure you're using the same number once you've determined it. Okay. And so we're going to divide, and we're going to see our return on assets is 17.33%. Right? So the higher the return, the stronger it's indicating for how you're using your assets to generate your net income. And we can see that the return on assets equals your profit margin, in this case it was 20.91, times your total asset turnover of 0.83. So we can see that's 17.33%. So we can break it down and see if we want to, if we're trying to increase our return on assets, we can look at which piece do we need to strengthen. Is it focusing on generating the profit, or is it focusing on efficiently using your assets to generate revenue? The next is looking at the return on equity. What percentage return did we earn on our investors' investment in the company, the stockholders' equity piece? So we'll take our net income and divide by our average stockholders' equity. So again, we use that same net income off of the income statement, and then we want to get our average stockholders' equity. So the beginning of the year, $90,488, plus the end of the year, $65,339, come to a subtotal and divide by 2. So we divide that by 2. We can see it's going to fall in between the beginning and the ending, 77,914. So we can see, look at this, we've got quite a nice return, very healthy return on our equity. 73.69% is the return we're getting on the amount that we have in stockholders' equity. And again, compare that to our return on assets. The difference is how well we've been able to use debt in our company to generate net income. So that's a strength for the company. The last thing we're going to do is look at the market prospect aspect. How do we evaluate stock as an investment? And I mentioned in the lecture video that the price earnings ratio, the PE ratio, is something that stock analysts watch and calculate. And so we're going to calculate this by taking the market price and dividing it by the earnings per share. So we want the market price as of the last day of the accounting period. So the last day of our accounting period is September 26, 2020. So they have kind of a weird year end. It's the last Saturday in September, right? In 2019, it was September 28th. We're used to seeing the last day of the month being the last day in the fiscal year. So we want the market price, the stock price as of close of trading. So that would be actually September 25th is the Friday. So that's the day we want to see. So in order to get the market price on that date, I like to look, there's a few ways to do it. I like to go to Yahoo Finance. So if you go to Yahoo Finance and then you can start typing in the stock symbol. If you start typing in the name, how does that come up? Apple, right? AAPL is the stock symbol. So we want Apple, right? And we can see this is what it's trading for today, $144.84. You want to go to the historical data because we want to know what was it on September 20th or September 26th of 2020. So you go to historical data and here's all of the stock prices. So you can go back and see the stock prices. We want to change the time period. So we want to know what was it on, I'm going to put in 09. I'm just going to give it a little bit of leeway, 2020. The end date, I'm going to put 09/30/2020, right? Because our date was September 26th. So I say done and then apply that filter. Okay, so we can see September 25th was the Friday. This is where they were because there was no trading on the 26th. And we'll use this adjusted close of 111.56. So that's our market price. So that's what investors are willing to pay for a share of stock. Let's see what earnings will they get on a share of stock. We need to go to the income statement, and the earnings per share is shown on the bottom of the income statement. And it's basically how much net income do you get on one share. So here they're dividing it by the number of shares. Okay, and so we can see if you go on in accounting, you're going to learn there's a little bit more involved than that in getting, especially the difference between basic and diluted. We use basic. So we're going to take that $3.31. So that market price divided by the $3.31. Okay, so the market price, 111.56 divided by 331. We get a PE ratio of $33.70. Now this is going to look different when you compare it to the book. They had a stock split and that adjusted the market price per share, the earning price per share. We'll learn about stock splits in a later chapter, but we'll go off of this amount that's been adjusted. And so we can see investors are willing to pay $33.70 to get $1 of earnings. So that's a lot to pay to get $1, but that's because they think that the company is going to do well, that it's going to be a strong stock. So they're willing to pay a lot. There's high expectations is what that means. Stock analysts might say this is an expensive stock. They want to find a cheap stock that maybe nobody knows about that they think is going to have they have things in the pipeline that are going to make it valuable, that is going to make the company generate net income and then have a higher stock prices going forward. So stock analysts a lot of times are looking for the cheaper stocks that they think have a lot of potential. The investors are expecting a lot from Apple, which isn't a surprise, but that's what this means. They're willing to pay $33.70 to get $1 in earnings.